Improving Alpha Innovation in Investing, ESG and Technology with Michael Oliver Weinberg in partnership with Vidrio Financial. Vidrio Financial is a premier data management provider shouldering the responsibility for your data from collection to extraction, transformation and enrichment. Vidrio monitors over 2,000 diverse funds, processing millions of data points each month. Discover how Vidrio empowers your institutional portfolio data by combining advanced AI and human expertise to yield comprehensive analytics on performance, cash flow, risk, valuation, and more. All delivered seamlessly through Vidrio's Data Management Hub. Save your investment team valuable operational time, providing actionable insights like never before. Explore more at vidrio.com.
Hi, this is Michael Oliver Weinberg. Welcome to the Improving Alpha podcast, where we explore innovation in investing, ESG, and technology. Today, Frank Mihail, Chief Investment Officer of North Dakota Trust Lands, joins us. We will dive into his background before tackling the core trends shaping the industry. Investors, academics, and business leaders alike will gain immense value from his unique insights. On that note, welcome to the show, Frank.
Thanks for having me, Michael. Appreciate you inviting me on.
Our pleasure. But why don't you start with your background, briefly how you got to where you are now?
Yeah, sure. Love to. I grew up in Los Angeles, studied mechanical engineering in undergrad, and worked as an oil and gas engineer in Los Angeles at a college. And that wasn't quite the right fit for me. So I exited that industry and got my real estate license, and I started selling real estate in Beverly Hills, and my timing was impeccable. I decided to do that in 2008, and I got a taste of apartment building investing through doing that, and really just got a hunger to learn more about investing. So I switched from real estate sales to financial advisory sales or private wealth management at the age of 30. And I was hungry to learn. I got my CFA. I enrolled in the part-time MBA program at UCLA. And after about 7 years of private wealth management, I used the MBA to pivot into institutional investing. And I got my first role with New Mexico PARA, the public pension in Santa Fe. In my late 30s is when I entered the industry. And I moved up quickly. I got the opportunity to build a hedge fund book and a portable alpha program under the direction of the former CIO, Dominic Garcia. And then, after 4 years of working there, I got the opportunity to join the state of North Dakota as the Chief Investment Officer, and that's where I am today.
Great. So that's a good segue to North Dakota. What's the objective? Why don't you give us that and sort of, to help us contextualize the discussion? Not all listeners will be familiar with it and, how it came about and what its goals are.
Yeah. So I guess one thing to know, North Dakota has 2 sovereign wealth funds. So we're North Dakota Trust Lands. We manage one of the sovereign wealth funds. It's a sovereign wealth endowment, much like a permanent fund. If you're familiar with Alaska and Texas's permanent funds, we operate very similarly. So we generate revenue from oil royalties and taxes that comes into our office. We've built now a $9 billion endowment, and we pay out a 5% annual distribution to fund public schools in North Dakota. And right now, the amount that we contribute covers about a quarter of the cost of public education in the state. And we're projecting that in the next 20 to 30 years, we may be able to cover the entire cost of public education in the state. And that all translates into tax relief for local citizens, because we would otherwise need to generate that from property taxes and the like. And just a sort of fun fact here, North Dakota is the 3rd largest oil producing state in the nation. Texas is number 1. They produce about 5 times more oil and gas than we do, but their population is almost 50 times larger than us. And so what that means is every dollar that we generate is about 10 times more impactful on a per capita basis.
Yeah, it makes sense because you have so few people, right? Yeah, those are our fun facts. And I had not realize the magnitude of those myself. And then let's talk about innovation in alpha and improving alpha. How are you innovating to improve alpha from an investment perspective?
So when I joined, and historically, the fund has been more conservatively postured or positioned, given that we are an endowment and we're not a pension, we don't have liabilities, we do have the ability to take risk. And so I've been slowly trying to move in that direction from more fixed income to equity oriented. And we are one of the healthiest institutions in the nation. We're net positive cash flowing right now, meaning we don't have to touch principal to pay our distributions. And so when I joined in 2023, we didn't have a venture capital book, so I started to build that out. And I've also repositioned our public equity book from long only to using long short extension strategies, if you're familiar with 130-30. And I think one of our biggest challenges when I joined was we were struggling to find a good infrastructure benchmark. And I think the whole industry struggles to find a great private infrastructure benchmark. And so for the last 3 years, I've been advocating for better benchmarks in private infrastructure. And I think we're just starting to see that come to fruition, where I think there's a few groups that are going to be launching something here pretty soon.
Got it. And then within venture, is there a particular stage of venture you've been focusing on, early, mid, late, specific sector within subsector or within venture? Or
We invest across the spectrum. And so one of our biggest challenges is we're 3 people managing $9 billion. And so the operational burden is our biggest challenge. And so we try to find areas where we could be more efficient in putting the capital to work. So it's hard for us to go out and like write a $5 million check to a seed fund. We're more like, if we can write a single $50 to $75 million check and put that to work on at a platform that could diversify it for us. That's more our approach.
wow, yeah, so there are 3 of you running the 9 billion. That's a low ratio of staff to assets. And so how do you leverage then the sort of small team to invest that, aside from what you just said on venture, for example?
Yeah, so we're all generalists, and we kind of like roll up our sleeves and help out across the board. We don't have like asset specializations or anything. I kind of try to just, divvy up the work across the team. And then we also do have some external resources. We work with RVK as our consultant. And so any diligence that we're doing is sort of, side by side with them as well.
Oh, I see. So you got to use an external consultant. Got it. That makes sense. So they do a lot of the heavy lifting in terms of ODD and IDD and it's operational due diligence, investment due diligence, for example.
Yeah, that's right.
Got it. And then if you look at the portfolio more broadly, you mentioned that some of the innovation you've done is venture and 130-30 long only extension strategies. But aside, if you look at the portfolio more broadly, like what does it look like at a high level?
So we have a target of about 45% to private markets. So that's across the board, equity, credit, real estate infrastructure. And then we have about another 35% in long short, and that's split. We do have a dedicated hedge fund book that targets zero beta. And then in our public equity book, we're using those long short beta 1 extension strategies. All that exposure combined is about 35% of the book. And so when you add up the 45 and 35, that's about 80% of the book is in alts. And then the other 20% is pretty much just passive, and we think of as our sort of liquidity pool, passive equity and fixed income.
Makes sense. Okay. And then what about from a technology perspective? How, if at all, do you innovate from a technology perspective to improve alpha?
I hesitate to use the word innovate when it comes to our technology capabilities. I think we're more of a a laggard than a leader here in this space. We are trying to use AI to figure out how we can expand our efficiencies. And so we're just working on trying to get a tool approved by our IT department that we can start using, an enterprise version that is secure, and that way it can help read through all of our docs and make the legal and the diligence process more efficient. When I joined, actually, we were basically running everything just in Excel spreadsheets, like the performance and monitoring. And so I was going to the board, giving our board meets about 10 times a year, it's a little less than a monthly cadence, and we were doing performance reports like manually in Excel. And so I've moved away from that and hired a cloud vendor that does our performance reporting. And I'm now talking to some other vendors to try to figure out like how we can add AI to the product suite.
Makes sense. That sounds like the right thing to do. Okay. And then, again, we mentioned venture, we mentioned your strategic asset allocation. Where do you think the best opportunity from an investment perspective is now?
The two asset classes where we're adding capital this year are private equity and infrastructure. Those are driven by our underweights and our strategic asset allocation target. I am very excited about the opportunity set in infrastructure. We're playing more in the, if you think about the risk profile of real assets, core plus, value add, opportunistic, we play in more of that like lower risk spectrum of core risk. It's more income driven. And, right now with the inflation outlook, I just love that sort of inflation protection that you're getting from infrastructure. So we're going to continue to put money to work there. And then, with everything in the news, outside of that, with everything in the news about private credit, we also have a private credit secondaries strategy that we're committed to and really excited about the opportunity set as, some of these, BDCs and other open-end private credit funds need to provide liquidity. They'll need to sell on the secondary market, and hopefully we can pick some of that stuff up at a discount.
Have you looked at any of it yet, or?
So, we hire an external manager. So we've made a commitment to a fund there that does the work. We're not looking at individual secondary deals ourselves.
Got it. Do you know what kind of spreads or discounts the secondary manager is seeing on these or
it hasn't gapped out as large as we were sort of hoping just yet. I think they're still sort of trading in the 90s, maybe 85 cents right now.
Right, got it. And what kind of returns are you expecting on the infrastructure that you mentioned before we talked about the secondary private credit?
We're expecting high single digits, but for the last couple of years, we've been getting double-digit returns from the core infrastructure book, which is beyond our expectations.
Got it. Are those IRRs or time-weighted returns?
Those are time-weighted.
Got it. Oh, that's respectable then. And what anything you think is least attractive now from an investment perspective or least interesting?
Obviously, real estate's been a stick in the mud for the last couple of years, and it's, a lot of those trends are secular, right? Like when you see, for example, when retail went out of favor a decade ago, it stayed out of favor for a decade, right? And so I think real estate being so interest rate sensitive and the outlook for rates to be higher for longer, I just feel like real estate, might just continue to flatline here for another couple of years.
Yeah, well, that's a whole longer conversation, but fair enough. And what's the biggest challenge to achieving your goals at the fund?
I think it's really just having patience, because a lot of these goals, they take time to implement. And, when I've got an idea to make an allocation or implement something, I want to get it done today, but we've got limited resources. We don't have investment discretion, meaning I do need to go to my board for approval with every new investment recommendation. And so it could take 3 to 6 months to go soup to nuts through an investment diligence process, and it could take years. So what I mentioned earlier about like our infrastructure benchmarking issue, I've been working on that for a couple of years now. And when you have a big idea change like that, it could take years, and so you just gotta have patience.
Right. That makes sense. Having worked at similar large asset owners, these things can take time. And what's a red flag with a manager that would preclude you from investing?
There's a few red flags that we look at when we're underwriting. Seeing turnover, like high turnover within a team, is always a red flag for us. Misaligned incentives, if there's low GP commit, or they just sort of don't seem like a great strategic partner, like if they're just concerned about raising as much money as possible. Maybe strategy drift over time, and maybe just that asset gatherer approach where if you see large growth from in raising capital from one fund to the next.
How would you define low GP commit?
Zero. Yeah, because like nowadays it's like less than 1 to 3%, I guess is pretty normal standard.
Yeah, that's right. I think 1 is probably low, but 2. I think 2 is probably the average. But so then maybe 1 was the lower end, yeah. And then sometimes you get 3 and even up to 5. But yeah, and then and then what's a material mistake you've made investing in, a lesson learned?
When I was at my prior agency, I was running the hedge fund book and I was building a portable alpha hedge fund program from scratch. And I was kind of like, this was my foray into the industry. I was really blessed to have the opportunity to be in that position without sort of any prior hedge fund experience. And I felt like I was a kid in a candy store, because I was like thinking, no, give me one of every hedge fund strategy, right? Like diversification, just give me one of everything, one equity long short, one CTA, one macro, one fixed income RV. And I built this 10 manager portfolio with diversified strategies. And I ended up redeeming from one of our managers because they had a double-digit drawdown in 1 month. And that's when I realized I didn't really have the stomach for that kind of volatility that is offered by directional strategies in particular, which is like the CTA and the macro strategies. Those are great strategies, don't get me wrong, and they're phenomenal at delivering uncorrelated returns. But what I realized was it didn't fit the goals of our portfolio, which was just to generate consistent, dependable alpha. Like I wanted 50 bips of alpha a month so I could sleep well at night. And with the directional strategies, you get these, they're great at delivering uncorrelated returns, but that cuts both ways. So they could be up double digits in a bear market and you're cheering, but they can also be down double digits in a bull market and you're just like, and that's sort of what happened to us. So I think what I learned from that whole process was, the goals, when you're allocating to a manager, it needs to align with the goals of your portfolio, and you need to understand the vol profile and have a stomach for that downside vol.
Yeah, I think that's definitely 100%. Do you have a view? So it's funny because we've been doing this podcast for many years now, and inflation is like, it's been irrelevant, then it's been highly relevant, or we've done it through periods of disinflation and then inflation and even, maybe hyperinflation. It's kind of timely again with, I think, the Strait of Hormuz. Do you look at inflation? Does it matter? Does it not matter? And if so, how does it impact your strategic and or tactical allocation, or if at all?
We are ramping up that infrastructure portfolio, as I mentioned. So from a long-term strategic perspective, we're adding some of that inflation protection there. From a more short-term or tactical perspective, we also do have a bond overlay program that allows us to lever up our core fixed income in a sort of portable alpha-esque type way. And we did have that turned on, and I just turned it off actually just last month because I did start to, we use kind of like we've put together a dashboard with Fed signals that's driven by like inflation and employment data. And so we want to go lever long when we think rates are coming down and turn it off when they're not. And so our signals were all kind of flashing like now's not a good time considering the direction and the path of that inflation was signaling. And so we did turn off that bond overlay program.
Yeah, I mean, personally, I think we're due for a prolonged period of inflation accelerating, if anything, and for various reshoring, AI, Hormuz, Iran. But okay, either it could be investment or non-investment. Any book you've read lately or a favorite book that you recommend to listeners?
Yeah, one of my favorites that I've read in the last year, Unreasonable Hospitality by Will Guidara. He was the restaurant manager at 11 Madison Park when they won #1 restaurant on the world's 50 best list. And coming from an investment background and an engineering background where like most of the stuff I've read has always been like technical white papers, this one was so refreshing because it's such an easy read. In the last decade, it's probably the only book that I was able to read like cover to cover, like in 2 days, because this, it was so good the way he sort of writes it. So it's a really pleasurable read. But he goes on to basically talk about how they won best restaurant in the world was just going above and beyond when it comes to service and hospitality. And a lot of the lessons that he teaches doesn't really apply just to the restaurant industry. It's something that you can, all of us can apply in our personal life or at work. And it's just, thinking about like putting other people first and being empathetic and going out of your way to like make someone smile. So like it's really thoughtful to think like, what, do I have to give roses to my wife only on Valentine's Day? Like, why not just a random Friday, to make her feel special? And so it gets you thinking like what you can be doing to make the people close to you happy.
Cool. I knew Will's father, Frank, but I just got the book, so I'll look forward to reading it. Thanks for that. And any advice you have for other allocators and or investors more broadly?
I would say don't be ashamed of the B word, beta. Our whole industry is like driven around alpha, and everyone's goal is to deliver alpha. But if you think about like when you look at like the peer ranking lists of like who the best performers are, a lot of times it really comes down to more just strategic asset allocation effects rather than manager selection alpha. And so like if you look at some of the top institutions, these over the last decade, a lot of the reasons they're top institutions from a return ranking perspective is because they had crypto beta in the portfolio. And so, yeah, I guess just, don't be ashamed to use beta as a portfolio construction tool.
Yeah, I couldn't agree more. Anything we didn't discuss that we should have, or that I didn't ask you that you think is timely and topical, or you're discussing with your investment committee or consultant? Anything that we kind of missed, or that you think is poignant or relevant now?
Well, I mentioned that we are a small team, and that has been like a blessing and a curse for us. As a small team, we don't really have the manpower to build a traditional private markets portfolio. When you think of like closed-end funds and co-invest, a lot of those large institutions who are like 100 billion plus with 50 to 100 person teams, I think they're able to drive alpha using their size because they can co-invest and they can negotiate fee reductions and revenue sharing agreements. So I think the result of having a smaller team, our effective fee load may end up being a little bit higher, but we're still able to generate meaningful alpha from our manager selection because we're not over diversified. We've got a little bit more manager concentration because we're writing fewer larger checks. The other thing is TPA, total portfolio approach, is a real hot topic in the industry these days.
Oh yeah, that's for sure.
And I gave it a thorough look and decided it didn't make sense for our small team, because the way I look at it is TPA solves a problem for the large teams. If you've got 1,000-person team and you've got your real estate team investing in a data center manager and your infrastructure team investing in the same data center manager, and they're not even talking to each other, or they're competing for capital, TPA solves the problem of breaking down those walls and creating a unified team goal. The trade-off is, in order to do that, it creates more opaqueness, because you've got to remove your asset class targets and benchmarks. And so for us, I thought, hey, since we're a 3-person team, we're all generalists and we all talk to each other every day, we don't really have that siloed team problem that needs to be solved. And so we kind of get the best of both worlds already, where we're a unified team and we can still keep those strategic asset allocation targets and benchmarks to give our board the transparency that they want to see around those. So I think TPA is a great approach for those larger teams, but it just didn't make sense for us.
How many positions do you have? Because you mentioned you're fairly concentrated.
Yeah, so we're about 30 relationships, about 40 line items.
Got it.
So each asset class is like 3 to 5 line items. It's pretty concentrated.
Yeah, well, that makes sense. And then also you don't have as much netting risk if you have less manager count. Right. That makes sense. And I agree. If you're lean as you are with 3 full-time investment staff, I don't think you need a total portfolio approach. You're probably pretty aware of what the other 2 are doing and vice versa. I agree. And I think, anyway, total portfolio approach is another whole long discussion we could spend hours on, but we won't. Okay, well, thanks, Frank. Thanks for the fascinating discussion and sharing your most valuable asset with us, your time. We hope listeners have a deeper appreciation for your perspective and how we can all apply those insights as investors and allocators. This is your host, Michael Oliver Weinberg, inviting you to join us next time when we speak with another thought leader on improving alpha through innovation. Thank you, Frank.
Thank you.
Thank you for joining us on the Improving Alpha, Innovation in Investing, ESG and Technology podcast, presented in partnership with Vidrio Financial and sponsored by Alternatives Watch and PEVC Tech. Vidrio Financial offers a cutting-edge data management solution that not only collects and cleans your data, but also empowers investment teams to cut through the noise and extract valuable insights for better decision-making in areas such as valuation, risk assessment, and portfolio management. If you're an endowment, foundation, pension, sovereign wealth fund, asset manager, OCIO, or family office facing challenges with your data pipelines, we invite you to connect with us today and explore how Vidrio can seamlessly integrate with your investment team to enhance your data management capabilities. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Vidrio Financial or our host, Michael Oliver Weinberg. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding investment planning.